Welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be headed over the near term here. So this week it's all about the follow through on a Fed rate cut. We have a rate cutting cycle now underway. We can see right here, this is the upper limit of the Fed funds rate, coming down a quarter point last week. But here's what's interesting. This is a deeply divided Fed, okay? That's what Powell's comments, other data coming out from the Fed, they are deeply divided, and we'll get to that in just a minute. But again, their latest rate setting meeting, the Fed cut rates a quarter point as widely expected. The updated projections from Fed members points to a couple more rounds of rate cuts before this year is out. But those projections are far from unanimous. Of the 19 officials providing forecasts, 7 saw no need to cut rates any further from here. Just leave them right there for the rest of the year. And that's because we've got this dual threat of rising inflation along with the weakening that we've seen in labor market data that is dividing central bank officials. And even Fed Chair Jerome Powell commented that, and this is specifically what he said. He said that it's challenging to know what to do, and he said that further rate cuts are on a meeting by meeting situation. So despite the uncertainty, various market gauges, they are still confirming, they're pointing to that more rate cuts ahead, falling in line with kind of what the Fed, their own projections are. Market implied odds from the CME that points to 4 cuts over the next 12 months. I prefer to look at the 2-year Treasury yield because it tends to lead changes in the Fed funds rate. It's currently 0.68% below the level of Fed funds. So that implies, somewhere around 2 to 3 rate cuts to get down to where the Fed fund, or to get down to where the 2-year Treasury yield is at. But look, here's what we know. We know the Fed cut rates, and that means, since the Fed cut rates, that means the Fed is joining the rate cutting party that is already well underway all around the world. So this chart shows the percentage of central banks that are cutting rates, that's the blue line, versus central banks that are raising rates, that is the red line on here. On a global basis, 84% of central banks, their last move was to ease monetary policy by cutting interest rates. And now you've got the Fed, the largest, most important central bank in the world, is joining that party. And here's what we're seeing. We're seeing the central bank concerns pivoting toward the labor market. But here's the thing, rate cuts are coming along with loose financial conditions. So financial conditions, a way to measure the cost and availability of credit is already much looser than average. Now we're throwing rate cuts on top of it. That could deliver a spark to both the economy, but it could also stoke inflation. We'll talk about that in just a minute. Because look, at the same time, you have more evidence. More evidence is building that the economy is doing much better than many investors and economists believe. You can look at the most recent data on retail sales for August. You can look at the setup in cyclical stocks and sectors. All signs are pointing to a positive outlook. So this week, let's take a look at these deep divisions that are emerging within the Fed. And what I would say was a very, very surprising outlook for the Fed to bring inflation under control. Now, we'll also look at how the market tends to perform once the Fed starts cutting after being on hold for an extended period of time. And then I want to unpack that positive message coming from cyclical stock market sectors on the outlook. But let's start with the Fed. Now. So periodically, alongside their rate setting meeting, the Fed will release its members' projections or forecasts on things like economic growth, unemployment, where the unemployment rate is going to be, their outlook for inflation. While the median values of those projections tends to get a lot of attention, you need to focus on the recent forecast, because recent forecast shows that there is not a clear consensus. You should not rely on the median because there is not a clear consensus. This chart shows the dot plot, what they call the dot plot from the Fed's summary of economic projections. And now recall that the median value for 2025. So the median value for 2025 calls for 2 more rate cuts this year, where you look at where this is falling in at. But 7, so right here, this group, 7 of the 19 members providing forecasts saw no need for further rate cuts this year. And here's the other surprising thing. The Fed, when you look at their projections, they do not expect consumer inflation to return to the 2% target until 2028. So it's a bit of a head scratcher why the Fed may have elected to cut rates here, despite this dissension that we're seeing unfolding within the ranks of the Fed itself. So the Fed originally started cutting rates a year ago. It reduced the Fed funds rate by 1% in late 2024, but the central bank has been on hold since its last rate cut in December. Now, historically, a renewed rate cutting cycle after being on hold for 6 months or more has been a positive thing for the S&P 500's forward return. So that's what the chart on here is showing. It's showing how the S&P, on average, tended to perform in the 12 months, so this is this 12-month stretch before the Fed started cutting rates again, and how the S&P moved once rate cuts resumed, so then the 12 months after. What's interesting is that you can see this drop ahead of restarting rate cuts. That actually lined up pretty well with the sell-off we had into early April and the trade war headlines. What we got to pay attention to now, so here's where we are now. We're at this dashed line. You want to watch what the S&P 500 does looking ahead, and historically the S&P tends to see a really steady grind higher. Again, this is on average over the next 12 months once the Fed starts to resume rate cuts after they've been on hold for a while. So large cap stocks in the S&P 500, they tend to experience strong average gains when the Fed starts to resume rate cuts. That's using historical data. But one area you need to keep an eye on is with small caps. Small caps in particular could be a beneficiary here. That's because small caps get more of the revenues and earnings from the domestic economy, so falling rates could help boost domestic growth. Small caps could leverage that better. And about 33% of small caps, at least with companies in the Russell 2000 index that track small cap stocks, they are financed with floating rate debt compared to just 6% for the S&P, so that rate cut can be immediately felt on the bottom line for small cap stocks that have floating rate debt. Now, historically, small caps have outperformed both mid and large caps whether you're looking at 3 months. This blue bar is the first 3 months, then 6 months is the green bar, and then this orangish bar is the next 12 months. Historically, you can see looking out, small caps over those 3 time frames have done better than mid caps, which have done better than large caps. So keep an eye on how small caps are performing right here, especially as the Russell 2000 index is testing its prior highs here once again. While historical data does tend to favor more gains in the stock market now that the Fed is cutting rates again, the ultimate path for stocks, it's going to come down to one thing, and that is the health of the economy and the outlook for corporate earnings, how that impacts the outlook for corporate earnings. Now, I've been pointing out there has been evidence that the economy is not showing signs of slowing, it's showing signs of accelerating. We've had the August retail sales report come out last week. That flew under the radar. Retail sales were up 0.6% in August. It was a strong month. It beat expectations because of better consumer spending data. That's boosting the Atlanta Fed's GDP Now model. It's currently running at over 3% annualized growth for the third quarter. But here's the thing. We want to look ahead. Stock prices, they discount future business conditions, and there are positive signals among key stocks and sectors that are sending that positive message. We've talked recently about the setup in regional banks. Regional banks could be setting up to move to record highs. That's a good sign. But this chart here shows a machinery giant Caterpillar. It is an economic bellwether. Its stock is working higher after moving out to new highs over this 400 level back in July. So that's what this shaded box on here shows. This 400 level tested several times, broke out above it back in July, and then created another bullish setup where we had stock price making smaller pullbacks, higher lows along the way, while surfing this 50-day moving average and then breaking out last week once again. This is a great sign for the outlook. Caterpillar is exposed very much to the health of the global economy, and that is why you're seeing Various cyclical stocks like Caterpillar and other sectors like banks are sending positive messages on the outlook. So a rebound in the economy, we want to see that drive a broad earnings recovery because that will be needed to sustain the bull market rally. And while earnings growth is projected to broaden out into the end of next year, into the end of 2026, the trend higher here in the S&P 500's 2026 earnings per share estimate has been really driven by the Magnificent Seven. We know the Mag 7 has been a huge driver of earnings growth over the past couple years. Well, they're driving a recovery in earnings for next year as well. And so what this chart does, it's benchmarked to 0% at the start of April, and it looks how the S&P 500's 2026 estimate has evolved. You can see, so the S&P 500 overall is a darker blue line. You can see the drop following the trade war as estimates were revised lower due to the uncertainties caused by tariffs. But now we've seen this rebound as the markets rally, but that rebound has been fueled by the Mag 7, this green line on here. You can see Mag 7 earnings per share relative to where they are in April are now higher. This percent change is moving into positive territory, and that's bringing the S&P up. Meanwhile, you have the other 493 just trending sideways, but now starting to see a bump right here. And so this is important. We need to see this expanding breadth of earnings contributions if you want to see the overall rally in the S&P 500 and the overall stock market continuing into next year. All right, next week, a couple things that we want to keep an eye on for this week. One is going to be with this manufacturing PMI. Within both the manufacturing and services PMI, keep an eye on the new orders and inventories component. We want to see new orders continue to recover, and we want to see customer inventories falling to low levels. That indicates restocking demand. Both are a positive for the outlook ahead. So keep an eye on those PMI reports, and also keep an eye on Fed Chair Powell and the comments that he has following last week's rate reduction, and and how he's viewing the risks across inflation versus the labor market. Those are going to be the big reports this week, but then also keep an eye on this core PCE price index. This is the Fed's preferred inflation gauge. I thought it was really interesting in their economic projections that the Fed does not see core inflation at 2.9%. They don't see this getting down to their 2% target until 2028. That's a shocker to me. It's very surprising that they're willing to tolerate inflation running that far above their target and coming out and cutting rates here. Let's look at some chart setups for the week ahead. I think you need to keep a close eye on ticker VRT, Veritiv Holdings. This is an AI infrastructure stock. This is a way to play the AI theme via a pick and shovel play. This is particularly exposed to the data center build out. And so what do we want to watch for this pattern? Well, we had this peak back earlier in the year, the sharp pullback. This went into the April lows along with the rest of the market, recovered to near the prior highs around this 155 to 160 level, and now we're seeing evidence of accumulation. You've had one smaller pullback and are now rally back to that level. What I would really like to see right here is just one more smaller pullback off a test of 155 or 160, and then I think that sets up the breakout to new record highs, and that would be the buy point to get in to VRT. That would be the point that I believe skews risk return in your favor. Some confirming indicators we want to look for. We want to see this RS line at new highs. We also want to see a big pop in volume as evidenced by this volume standard deviation indicator. When you have much higher than average volume on a move, you get these big purple bars, and that's what we want to see on a breakout with VRT. One stock that's had an absolutely incredible run. We've been flagging this setup in the quantum computing space. We've had several quantum computing names on our radar, and RGTI is one that has just absolutely taken off. It's clearing the two big resistance levels that we were tracking for the stock. The initial one shown with this gray shaded box on here around the 1750 level or so. This price bar taking out that initial level we wanted to see on a big jump in volume. And then the follow through you want to see there is a move to new highs over this 20 level that we peaked out at earlier in the year. Now here's the thing. This stock in just a week is up 50% from this initial breakout. And look at these big volume bars that are coming in on this absolutely huge move in RGTI. You're seeing several other quantum computing names setting up as well. This has been an under the radar sector, but these setups, they are working. And so keep a close eye on these quantum computing names. With RGTI breaking out, we've seen the same thing with IONQ. This is going to be an exciting space to trade through the end of the year. All right, that is all for this week. Best of luck trading in the week ahead.